Yeah. Hello, everyone. My name is Ali Nuraldin. I'm a co-founder and core contributor at Opium Network. Opium Network provides an infrastructure for creation, trading, and settlement of decentralized derivatives. So what I'm going to talk today about and what are we going to learn here is what is an option contract itself, a little bit about the options market, current state of DeFi options, and a couple of option strategy examples that you can start with. So I wanted to share a little bit why I'm talking about this topic at all. I'm a software engineer for many years, and until some point in time, I was very far from anything related to trading in general. And of course, I didn't even know about what derivatives are and the options are, and considered the whole market and gambling and scam. So as I started working in DeFi, I learned what is financial engineering and completely changed my mind about the matter. So I hope my presentation will also change yours. It's a relatively complex topic, and complex and transparent DeFi is much better than complex and intransparent CeFi, as we can see recently. And I wanted to say a disclaimer that everything described in this presentation is not a financial advice, of course, so you have to do your own research before putting any money at risk. So what is the option contract? Option contract gives the holder of it the right to buy or sell a specific quantity of an underlying asset at specific price, called the strike price, on or before a specific date, depending on the type of options. So here on the table, you can see the type of the option contracts. They're separated into two categories, calls and puts. And each contract is a peer-to-peer. So every side of
I think we might have to start again so that we can stream live to the users. So
okay.
Just give me.
Well, it wasn't streamed before?
No, it wasn't going live. So right now it's when
okay.
it's going live. So yeah, let's Hassan, would you mind if you introduce Ali again?
Yep. Were we early?
Okay, we are going live.
Hi guys. Now we have Ali talking about option strategies in DeFi. Over to you, Ali. Opportunities in DeFi. Over to you.
Yeah. Hello, my name is Ali Nuraldin. I'm a co-founder and core contributor at Opium Network. Opium Network provides an infrastructure for creation, trading, and settlement of decentralized derivatives. So what are we going to learn here today is what is an option contract itself, a little bit about the option market, current state of DeFi options, and a couple of option trading strategies that you can start with. So wanted to share a little bit why I'm talking about this topic. I'm a software engineer for many years myself, and until some point in time, I was very far from anything related to the trading in general. And of course, I didn't even know what derivatives and options are and considered the whole market a gambling or scam. So as I started working in DeFi, I learned what is financial engineering and completely changed my mind about the matter. So I hope my presentation would change yours if it's not changed yet. And it's a relatively complex topic. And the complex and transparent DeFi is much better than complex and intransparent CeFi, as we can see recently. So, of course, I wanted to say one disclaimer that everything described in this presentation is not a financial advice. You have to do your own research before putting any money at risk. So let's start with what is an option contract. Option contract gives a holder a right or to buy or sell a specific quantity of an underlying asset at specific price called the strike price on or before a specific date, depending on the contract type. So here you see on the table, there are two types of option contracts. One is called calls, another one is puts. Option contracts are settled between two counterparties. So the one counterparty is called buyer or holder, another one is seller or writer. So I will just quickly go through it. So buyer of the call option has the right to buy an asset and buyer of the put option has the right to sell an asset. But sellers of the options, of the call option, has the obligation to sell the asset at specific price, and the seller of the put option has the obligation to buy the asset at specific price. Most of the time when option contracts are settled, buyers are paying the option price called premium to the sellers. So here are the payout charts of the different option positions. As you can see here on the top there, long call is a buyer of the call, long put is a buyer of the put. So basically, you can see that the call buyer makes money when the asset grows, and put buyer makes the money as the assets is depreciating in value. And of course, for the sellers, it's vice versa. The seller of the call option is starting to lose money with the assets price going up, and the seller of the put option is starting to lose money with the assets price going down. So it's very important to notice here that trading strategies involved in buying call and put options are much easier and less risky than the ones involved in selling because of different risk profiles. You will see it from here now. Take a look at the long call and long put payoff chart. You can see that the only potential loss on this position is the option price that was paid to the seller. However, the upside, meaning potential profits, is unlimited. And looking at the short call and short put charts, you can see that comparing to the long position, it has a limited upside, basically the option price that it receives, and the unlimited downside up to losing the whole collateral. So talking more about collateral, in order to ensure the potential payout to the holders of the options, writers must put a collateral into the settled contract. Depending on the type of a settled contract, options may be fully or partially collateralized. So normally in CeFi, bank would make sure that there is a collateral. However, in crypto, it may be different. It may be automated and secured by smart contracts. And we see that some centralized players don't even keep collateral for their spot tradings right now. So finalizing the theoretical part of the options, for better understanding, you can see the chart of the long put. This is what you are actually using on a daily basis. You are basically purchasing an insurance. You are paying the option price. This is maximum what you can lose. And if insurance event occurs, then it pays you out the payout, basically. So why people use it? Mainly for hedging in the trading companies, or for speculation like hedge funds or ordinary traders. And the overall market is huge. So I will show you the comparison here. I wanted to give you a little perspective on the difference between option volumes in DeFi, CeFi, and TradFi. I hope it's seen here. 1 second. Yeah, we can move it here somehow. So for rough calculations, to just give you a perspective, I took a 30 days volume in billions of dollars for top 10 option protocols by TVL in DeFi. For the CeFi, I took a deribits trading volumes, and for a TradFi, I just took Alibaba, Meta, and Tesla shares, US stock options. So you can see that CeFi volumes are 20 times bigger than the DeFi volumes, but on Alibaba, Meta, and Tesla stock generated at least 3 times bigger volumes than the CeFi. And of course, considering how much there are stock options there on the market, or stocks that are on the market, you can imagine the total volumes. I only wanted you to show you this so you can understand the potential growth of DeFi option volumes. Yeah, so what's the current state of DeFi options? To more easily describe you the current state, I separated the top 10 protocols on DeFi Llama into 2 categories: settlement protocols and DEXs, and DeFi options vaults, which became popular recently. Projects like Opium, Lira, Zeta, Opium Protocol, UMA, they're providing the settlement layer, the smart contract layer for settling the peer-to-peer or peer-to-pool derivative contracts, or they have dexes like order books or IMMs like Uniswap, for example, so you can come and trade with them directly. And the DeFi option vaults are Dopex, Friction, Tetanuts, Premia, Jones DAO, Katana, Opium Finance. They are providing automated trading strategies, basically automated option trading strategies for the users. So the users just deposit their assets and receive the interest. So the list is not that big, actually. There were more protocols, but they have smaller TVL and smaller available volumes. And currently, the majority of the users are market makers and very few hedge funds. So here we go to the option trading strategies. Considering the last slide, combining two topics like small volumes, liquidity, and small amount of projects give us actually the first trading board opportunity, arbitrage. One of the biggest problems in DeFi options right now is pricing, because there are not many participants and arbitrageurs. Market makers, markets are inefficient and prices are either too high or too low. So we need to fix that. And I'm gonna show you the first, then the easiest strategy here. So this is a simple arbitrage where you buy low, sell high, basically immediately. It's market risk-free, I would say, like in terms of the asset price movement. So the simple strategy could be is just you buy, for example, Ethereum call option for 10 base points on one platform, and you sell exactly the same contract for a higher price on another platform, and you immediately make a profit of 5 base points. Or sometimes you can even trade the correlated assets in this way. So let's say we can assume that 1inch token and ETH prices are more or less correlated, or you can calculate their correlation and include it into your strategy calculations. And for example, 1inch at price 83 cents is equivalent to Ethereum at price $2,000. So you can consider them correlated as well. And then you can buy like 1inch options for 8 base points and sell ETH options for 15 base points and make 7 base points on it. You can execute the strategy in different places. First one is obviously use dexes like IMMs or order books that I showed you before. Another one is not that obvious, and usually only people working in DeFi derivatives know about it, and it is auctions. So these projects that I showed you, they are having auctions on a regular basis, and they are selling or buying options in order to execute their strategy. And these options are different kind. It's Gnosis auction, Opium auction. Sometimes the deals are settled even OTC in the chat. So you can imagine how early we are on this market. The next one is a covered call strategy. So this is another way of trading options, and you can just do simply what automated strategists are doing, copycat their actions. And the covered call strategy is implying that you're selling call options which strike price is high enough, but the option is still liquid. So let me show you a real example so you can feel it right away. Here it is, like option calls on Deribit for next Friday, and the most, like the less risky and still liquid option here is with strike price 1,700, and you can still like buy and sell it here. And it's the same for puts. Puts, you can look here, the smallest, yeah, I'm gonna show you the strategy later, and the smallest liquid strike price is 800. Yeah, depending on the strike price, you get a better deal with the lower strike price, but immediately increasing your risk to being liquidated or forced to buy back your options. So when you sell the call options, you receive the premium. And since the options are tend to get cheaper with time, if the spot price doesn't move, then you have the possibility to get rid of the exposed risk and buy back the options at a cheaper price. Or there is another option, you can still wait. You can wait till the execution of the option. This way you will keep the whole initial premium and maximize your return. So talking about risks, execution of this strategy looks this way. Since the collateral is in the underlying asset, in case your option is in the money while executed, you are simply selling the underlying asset for an upon agreed strike price. So it's like a limit order, but with additional APR on top of it. And yeah, basically the risk is selling Ethereum at a high price here. So for many, it's not even a risk, but opportunity. Sounds cool. And another one is a similar strategy, but involving selling the put options. So here everything is exactly the same, but reversed, as puts are always reversed. You just have to sell put options which strike price is low enough but still liquid. What just I showed you right now on the Deribit. And again, here depending on the strike price, you get a better deal if the strike price is going to be higher, but immediately you're increasing your risk to be liquidated. And same as the previous strategy, options are tend to get cheaper, so you can either buy back the sold put options at a cheaper price at some point in the future, or you can just wait until the execution and keep the premium. Risks here are the same. So since you have in this strategy, most of the time you have collateral in stablecoin. So if your option will be executed in the money, you are just purchasing the underlying asset at the agreed upon price. So this could be also considered as a buy limit order with an APR, and risk is buying ETH at a low price. That's it, basically. Thank you for your attention. If you have any other questions left after the presentation, feel free to reach out to me in Telegram or Twitter anytime. Additionally, I wanted to ask those of you who haven't done it yet, visit the setalexfree.nl website and sign the petition for another cash developer who is reasonably imprisoned for more than 3 months already, and that's a threat for all of us and for open source development. Thank you.
Thanks for that, Ali. A great, insightful discussion there. Guys, if you are watching this, I know there's been some issues with our service provider. A recording of this will be uploaded in 30 minutes. And then in a few days, or I think within the next couple of days, we will have these talks on YouTube as well, and details of which will be sent to everyone. I'm just going to post into the channel a link to a face-to-face where Ali is going to be on, and you can continue the discussion there. Ali, I can't see any questions in the Telegram at the moment. So if there's anything you want to talk about for the next sort of 4 minutes, feel free to. Otherwise, I'll
well, in general, there are actually many different interesting strategies. I sometimes just experiment myself, sitting and trying to get the insights, because as I said, options and derivatives at all, they are they have a pretty good math. You can financially engineer it. There are a lot of formulas which you can use, and you can come up with many ideas, and market is so inefficient. There are many opportunities. Even just like staying on one exchange, there are opportunities, but bringing it between different exchanges just increases it tremendously. Yeah.
Awesome. Well, look, Ali, thank you again.
Thank you.